Here with Mo Rushdy of Riverwards Group. Thanks for having us, Mo.
Thank you for inviting me.
Awesome.
This is great.
So I guess the best place to start is tell us about this project, this beautiful building you got here.
It's an amazing project. You see what's surrounding us. We've got this big, I want to say 250, 300 unit new apartment building. And when we saw this piece, you know, part of what the Riverwards Group, when we started, is we were so big about single family home construction and projects in the city neighborhoods. And over the last 3-4 years, you've seen a lot of apartment buildings going up. And so we saw an opportunity here to bring in nice 2,500 square feet, single family homes with carports and mix it up, mix the neighborhood up. It's a great project. It's a 28 home project. First phase is 15 homes, which are the ones that we're sitting in right now. Next phase is about 13 homes. They have the full tenure.
Where we are right now?
We're at 680 North 13th Street. So it's kind of like, you know, it's a mixture of neighborhoods. You're a couple blocks off of Broad. You're about 5-6 blocks off of Girard. It's a nice, neat.
Right in the mix.
Yeah.
Yep.
Yeah.
It's awesome. Yeah, it's beautiful homes. I like the interiors. They look really nice.
Yeah, we wanted with this one to kind of really upgrade the spec level and the finish level to really provide this nice experience for people that want to live in the city. Now, you know, people who might be residents in one of the hospitals and they have to live in the city and they want to live in the city and wanted to provide space. You know, you've got a great deck upstairs with an amazing view, 2 car parking off street. We actually have a showing right now. We're sitting in the model home, and
you hear some noise in the background. There's activity going on over here, but
which is
these are for sale. So 680 North 13th.
And it's amazing. It's what a coincidence.
You said there's 28 of them here.
28
in 2 phases.
28 in total. 15 first phase, 13 next phase.
So, was it the bank's requirement that you did it in 2 phases?
Not really. I mean,
you guys just decided to.
Yeah, in single family homes, you don't want to build so much ahead of the sales, and you know it gives us an opportunity to see who the buyer is, see how our sales are doing, and so that you have the chance for the second phase to make adjustments, whether it's on the finishes level, whether it's floor plans.
Makes a lot of sense.
Yeah.
So like your adjustment might be, hey, these didn't sell as well as we thought. Maybe we downgrade the finish level a little bit. If
right.
Save on construction costs.
Right. Or vice versa. Right.
Or,
you know, this was an issue. Hey, you know, we wanted to see a powder room on the first floor versus on the second floor. Or we wanted to see, you know, more stuff in the master bedroom, in the owner's bedroom. We wanted to see more closet space.
Yeah.
So you get that chance to make these adjustments.
Yeah.
How often do you make it, like how long of a period, I should say, is between the first phase? Like how much time do you give yourself wiggle room to make that adjustment before you start building the second phase?
I would say somewhere between 90 to 120 days.
Okay.
So now that we're kind of pretty much all built on the first phase, we actually put the foundations in on the second phase. So we can build that second phase in about 5 months.
Awesome.
5 months from foundation to CO.
Foundation is already in. So it takes us 5 months to finish this project.
Nice.
At any point of time.
Wow, nice. That's pretty quick.
Yeah.
Found it you said there's 13?
Right.
Yeah, it's pretty quick.
Right.
This episode is sponsored by Excellium Construction, Philadelphia's premier siding installer. Excellium works with vinyl, metal paneling, fiber cement, and full building weatherproofing systems like Blueskin. They differentiate themselves from the competition by focusing on streamlining the process from initial customer interaction to project delivery. On a personal note, we've worked with them at Axe Philly and we've had a really great experience every time. They've always done exactly what we agreed to, which honestly in this industry is the best compliment that I can give to somebody. To get a quote today, you can reach out to them on Instagram at excellium.construction, XLEUM.construction, or visit their website at www.excelliumconstruction.com. That's XLEUMconstruction.com.
Oh, nice. And then your partnership, it's you and partner Larry, right?
It's me and Larry, correct.
Yeah, and then do you guys have like a specific split? Like you have certain roles and he has certain roles?
Yeah. Hey, listen, I Larry is my brother. I call him a brother because you know, it's one of the most amazing partnerships because we don't overlap much. You know, Larry has strengths and I have other strengths, and it came naturally. It wasn't agreed upon. It was just came naturally as we were, you know, founded the company and we were kind of like going through the first couple of projects. We saw where we fit. You know, I fit in the, you know, on the business side, getting the financing in place, getting the investors, pitching to investors, on the approval side, and you know, managing timelines on the upfront part of the project. And Larry's strength is, you know, Larry's a PE. He's a guy that looks at plans and says, you know, remove this, add this, and he would critique engineers, and he's able to do it.
Sweet.
And so it gives him that kind of edge on the field and the contracting part with contractors, and on the design part of the project as well.
Are you the GC on the project as well? Like, let's take this one in particular.
Yes, we are.
So he is basically the GC, and
Correct.
you're like finding the deal and doing the finance.
Correct.
That's
Correct.
exactly the partnership split that me and my partner have. So
Right.
I'm
So
happy to hear that.
Yeah, think of it as
You can get this
developer
big
and
with that.
GC. Right.
Yeah.
Right.
Sounds like, is that the way you guys always had it set up?
Always.
Okay.
Always.
Nice.
Always.
Sounds like a good split. So you're the one then that mainly handled the investor structure for this deal. 'Cause,
Absolutely.
You know, I told you when I was driving up and I saw how big of a project it is. I mean, it's, you know, two different streets, parking in the back, 28 homes. I'm just so curious what the capital stack looks like on a project like this.
Well, so you know, it's a project like this or any other project. Our stuff is, you know, we were blessed to have, you know, our capital comes from investors that started with us 10 to 12 years ago, and it started off with two investors, each investing probably about $100,000.
That's it?
That's it.
What were you guys building?
That was 3 homes.
Wow.
You know, that was our first project.
Yeah, I love this because like that's kind of where I'm at. It gets me so fired up to see how big you can grow from that.
Right. And believe
Learning
it,
moments here, guys.
and it's amazing. And it was no waterfalls, no preferred return.
Yep.
It was very simple. You invested 100,000, we'll give you back 150. Right? It started like that. And we're like, oh wow, okay, that's great. Guaranteed return. Yep. Personally guaranteeing it.
Yep.
And we're taking the risk because we don't have the money.
And you
to
take
do
their
it.
equity and you would go get debt on top of that.
Absolutely. The debt
Yeah.
part was not, you know,
Yeah.
tough for us.
Yeah.
You know, we've worked with other developers and we've worked in our previous lives where we have a lot of connections with banks. So it was the easy part.
So basically, raise investor equity, leverage that with debt from banks, which
Right.
you're already familiar with.
Right.
Start with a few single family homes and then scale up. And I'm
And scale
assuming as you scale, it gets a lot more complicated in the structure. Like you mentioned,
Absolutely.
like waterfall structures, preferred returns. Like, does this project have that sort of structure where?
So
you know,
we
it's-
grew to about 60 investors now.
Oh wow.
And these 60 investors can invest anywhere from 100,000 up to $1 million checks, right? So now we have a good group of investors that back us in every project. Now we continued not to have a waterfall, and our deal with our investors is a simple profit split based.
Beautiful.
That's it. You know, we look at the performers. They know that we're honest. They know that we don't overestimate. We actually always go on the conservative side when we're doing it. And through their experience with us on over 50 to 60 projects, it became very obvious to them that, okay, you know, these guys are hitting their returns or exceeding them. And so we had a little bit of an upper hand in how to structure the deals, and it was beneficial to them, right? We wouldn't have reached where we are today without their capital. And so it was very important for us that their capital has to be preserved and their capital has to be returned with the promised returns or with the projected returns. And that was one of the things that we were really adamant about, which is you keep on making your investors money. They will continue investing with you and they will grow that investment check. And for us, that's, you know, it's as simple as that. There's a very little bit of a preferred return, right? Very little preferred return.
Is it like deferred to any like capital event, like a sale or refi?
Absolutely. It's all deferred.
So you don't have a huge burden on your end in the interim while you're
don't
building.
have a burden from the investors.
Just from debt.
Right.
Yeah.
Right. And they're LPs.
That's nice.
Yeah. And they're LPs. And to us, it's a win-win.
So if they're LPs, then so you guys are the GP on the job.
Correct.
Here's something I never understood. As the GP on the job, you're the only one that personally guarantees on the debt. Right?
Correct.
How do you get around not having them personally guarantee on the debt if they own more than, I think, what is it, 20%?
Because not one of them own more than 15%.
Got
Right.
it.
So it's a
So you'll
15%
pull it.
threshold. Right. Because if you remember, like we just financed a huge deal, which is the Somerset Station deal, that we just had that groundbreaking a couple, maybe a month ago. That had probably over 50 investors, right? And 15 investors with a total, with maybe I would say, maybe the LP, I don't remember what the LP structure there, maybe it's 60% ownership. You know, if you have 50 of them,
So
not
you
one
would
person has.
syndicate through all 50 people would
Correct.
collectively own 60%.
Correct.
But not one person invests enough to own. If someone wanted to, would you say,
Absolutely.
hey, you can, but you have to now guarantee on the
You would
loans?
have to guarantee it, and if they're not going to guarantee it, we'd have to find a way with the bank and the lender to accept that they don't guarantee it.
If you ever run into that issue where somebody wanted more, but they just wouldn't guarantee,
Then you would have to change the structure.
gotcha.
You would probably have to change the structure.
That was kind of even, I got a little bit off topic, but I was just, it's
No,
personal
that's-
curiosity because
yeah.
we just ran into this where we had an investor that had 65% ownership in a 6-unit building. So it was one investor. It was a $400,000 equity position. And like we can't raise that from 10 different people. It would be an administrative nightmare.
Right.
So it kind of sounds like one of those things that actually becomes not easier, but simpler as you grow.
Right. It does get simpler. It does get simpler, and it does get simpler as you grow that investor, the number of people that are investing in your projects. Right.
Would you change it differently if going back? I mean, it sounds like it was relatively simple on that end from a raising, capital perspective. Like it sounds like if you would start over again, you'd probably do it very similarly.
We would, but remember, when you're starting and you have no experience of managing your own business, right? And to find someone, that $100,000 check was equivalent to us to a $10 million check today, right? You simply could not do the job.
Right.
So you wanted to put out an investor return that they cannot refuse. Hey, listen, this is going to be an in and out in 12 months. You're going to invest $100,000 and we're going to give you back a 40%. So are you telling us it's a 40% preferred return? Is that what you're saying? Yes, that's what we're returning. There's no profit splits or anything, but that's what you're getting.
Yeah.
Was it easier than now taking a step back, going back at the beginning for you guys, you had a lot of experience before you went out on your own. Can you kind of talk a little bit about that? Did that help when you start doing projects on your own because you worked at previous builders and just kind of tell us a little bit about that?
Absolutely. So I come from the Toll Brothers schools, right? And I call it a school because a lot of people in the market who have later on gone into careers of having their own businesses and, creating developer companies, they worked at Toll Brothers at one point in their career.
Toll Brothers University.
Yes, yes, it's amazing. And I was just going through my social media posts a couple of days ago, and one of the posts was the passing of Bob Toll.
Yeah.
Maybe about a year ago.
Yeah.
And I was just reading what I wrote, and it was sincere. He was a great mentor, right? He's a guy that was there doing business in maybe 30 states, has about 600 communities, and would be sitting in these quarterly land and project reviews, knowing every single detail about the projects when he didn't need to, right? He's a guy that would, work 10 to 12 hours a day, make sure he knows the ins and outs of every project. And they had a system.
Right.
And that is the system, and they had the discipline. And the number one thing you learn from working in Toll Brothers is that discipline. We have guidelines, we're going to follow them, right? There is no room for, well, let's try this, right? Because everything that they have reached out by the time that I was working with them, you know, when they have, you know, 11,000 or 10,000 employees and 600, you know, projects, they've reached there using being on a roadmap. They're like, this is proven. We know it. It's great that you have a great idea, but this is proven, and we're going to stick to whatever is proven.
Gotcha.
So that's you know, that taught me a lot.
So you plugged into their. How many years were you with them?
I was with them from 2004, from the time that I moved from Egypt to San Francisco East Bay. That's where I started with them. And then my wife got accepted in Penn in 2006, so I relocated with them.
That's what brought you to us here.
Yes.
Wow.
Yes.
There you go.
Thank you, Mrs. Rushdy.
Yes. It was. Let me tell you, it was amazing. It was amazing change. You know, I just, you know, seeing California as the first spot, I was like, wow.
Whoa.
Hollywood.
Was that your first time in
It
America?
was my first time in
America.
America. Yes.
What made you move here?
Well,
Sounds like
it
an
was-
interesting story
Yeah,
behind
yeah.
that.
It was just my wife and I. We had an option to either go to Canada or come to the U.S. We had these options for us, and you know, I was living a great life in Egypt, but
You were doing development, and you went to school for development over there as well.
for
correct?
engineering.
Yeah.
Right. My dad is an engineer. He's a developer.
So
And
real quick to interject, merging of the interests. Do you think that the ancient Egyptians built the pyramids, or was it aliens? what do you think? Tell me what's going on.
It's a lot of it. You have to go.
That's my number one
listen.
place. That's my number one spot to visit.
You see
Yeah.
the pyramids in pictures. I went inside of them.
Yeah.
It is beyond anyone's imagination. What you just go through these tunnels, and you know, if you've got kids, you're holding on your back, and then you go into these humongous rooms
It's
inside.
incredible.
Like
Yeah.
this pyramid, it's just not rocks on top of each other. You go in, and you're like, there's just rooms inside, and you're like, how did they build this?
So crazy.
I just don't get it. Like
But the
7,000
precision and like the detail and how it matches up with the
I mean,
stars.
they're 20-ton
Yeah.
blocks, I
Right.
think, right?
Oh
and
my
they,
God.
it's like a few million of them. So if
Yeah.
you do the math, I think it's, you know, you're setting one block every 8 minutes for like 200 years or something to get it done, like 24/7, which it's just an incredible.
And how do you get these blocks up that high?
Right. Yeah.
That's just amazing.
Mind
right?
blowing. Totally
It is,
mind blowing.
It is. So yeah.
Did
so-
that impact at all? Like just growing up there with the cool sort of architecture?
No, not really. I mean, listen, believe it or not, I grew up wanting always to be a doctor.
Really?
Always.
Wow.
Always. And I went into medical school and engineering school at the same time
Oh, wow.
in two different schools.
So, first of all, why? That sounds like,
Right.
it's like
That sounds like an
masochistic.
intense
I was a nerd.
life.
Let me put it this way. Yeah. I mean, I won't sugarcoat it.
Yeah.
Yeah. I finished high school before hitting 16. I think I was like 15 and
Wow.
a half.
Wow.
That's crazy.
Um,
And then
and
went right into
And I got accepted to
engineering
medical
and-
school and
yeah.
engineering. And after probably the first couple of semesters, I was like, you know what? I'm just gonna go this route. I would just continue in the engineering part.
And then you got your master's too, right, in Cairo
Correct.
or something?
Yes.
Yeah.
In the American University in Cairo. Yeah.
So then why engineering and not the full tilt with the doctor path?
I'll give you the reason off this podcast. But,
Fair enough. Fair enough.
it was a great school. There was
Yeah.
great
Just marry
parties.
one or something.
Okay.
All right.
This is the place I want to be in. No, seriously, no. I mean, my dad was an engineer. It was
Yeah.
a great school. I did look at the medical school. I wanted to always be a doctor, but it was like, oh my God, I'm going to go through 7 years of this. And then after that, I'm going to have to specialize, get into a fellowship. Oh my God, I won't even start breathing before
Start to
another
look at the
15 years
timeline.
from now.
Yeah.
Now, and you still develop in Egypt, right?
I do.
And
I do.
So I really want to know this, like, what is the biggest difference between developing here and developing there?
Listen, okay, so this is the part where, I was telling you, am I going to be opinionated here? Here's the difference,
Okay.
right? Egypt has gone through a lot of turmoil and in the last 10, 15 years has seen huge increase in the middle class and has seen, and you see that united will of growth and growing, right? everyone is like, all right, what can I do to help you move to the next step?
Wow.
And, this is partially because of an economy that's thirsty for growth, right? And an economy that is not mature. It's a developing economy, right? And which is like what China went through in the 90s, right?
And then it kind of seeped into the culture, essentially. Of
Right.
everyone.
Right.
Yeah.
Everyone. I mean, the government is just trying to help you in any way.
Like they see an entrepreneur and they want to help that entrepreneur succeed.
Exactly.
Whereas other places, maybe it's not as much like
Frowned upon. Yeah.
Right.
Yeah.
So, so comparing it to here, okay, well, here you have a mature economy already, right? So it's gone through its phases of development, of developing. And so the difference is there is, it's harder, much harder here to go through, projects and approvals and
harder in terms of like red tape and hoops.
Process, bureaucracy.
And bureaucracy and the politics,
What about the actual like building, like the execution of a build from a construction standpoint? Is it, I mean, is it difficult to find, like established contractors, or is
no, that's the one thing that you have so much of. There's a joke that half the country are engineers, and that's true. It's just like, engineering is a big thing over there.
Yeah.
So you've got a lot of contractors, you've got a lot of GCs, and you've got a lot of very complicated projects over there. And our projects over there are much larger than here because it's just the nature of the jobs over there.
What's the example of a project that you have going on in Egypt?
So we have a project that's like 1,500 homes. These are master developments that, will take 10 years to 12 years to develop, kind of like very similar to the stuff that you see in Florida, right?
Okay.
And
this is a separate company from...
It's a separate company,
okay.
Right. I'm one of 4 owners. And we have another job that's 4,000 homes.
Wow.
Both in Egypt. It's 5,500 just from those 2 jobs.
Just from these 2
and
jobs.
These are like communities, I'm assuming, where it's like you're basically building a suburb.
They're second home developments. And they're both shore developments. So one is on the North Coast and the other one is on the Red Sea. So these are second homes.
Is that like a luxurious sort of?
Well, you've got ranges from studios for $30,000 or $40,000 all the way to, $1 million home, right?
I'm curious on the financing side of those types of deals. Is it more complicated than over here, or how does that work?
Oh yeah. So Egypt has different rules when it comes to financing, right? Mm-hmm. You borrow money from the bank and you don't pay it. It's not like, all right, I'm going to declare bankruptcy. It has consequences.
Okay.
And these consequences are by law. Right? Hey, listen, you might be locked up for it. So, yeah, it's taken seriously. You're taking a loan, you have to pay it back.
Real skin in the game if you're
have
developing
to have
actual
absolutely,
skin. Yeah.
absolutely. But the way it works.
So does the leverage? Do you take on way less leverage then? I
I
would want to leverage like 40%.
As a developer over there, you're actually a developer and a bank. And when I say a bank, you're literally a bank. So you, as a buyer, if you're buying a home, you are actually giving me the full price of the home that I'm going to deliver in 6 years. You're giving it to me now through post-dated payments and checks at agreement of sale for the next coming 9 years or 8 years, right?
Interesting.
That money is cashed at these, of course, when I say the word cash, it's much more sophisticated than that. It's deposited in a bank, and then you have a cash flow to build the project. So in essence, the buyers are building the project.
So you're definitely doing phases over there.
Oh yeah.
You have to.
Oh yeah. A dozen phases.
So because when you sell out the first, you essentially have cash flow coming in.
Well, the cash flow pays for everything. So
wow.
In essence, it's your checks as a buyer that are paying for the construction, paying for the sales, paying for the operation of getting to, delivery.
Are you nervous of people not paying their bills and that impacting
Sounds like they would have skin in the game too. Same rules, right?
Exactly, same rules. And if
Interesting.
if a check gets bounced, they have a grace period. But then you can get out and you'll get your money returned less 15% of the price, let's say, of the house as a penalty. So no one wants to have their checks bounced.
And
So
they probably don't have a lot of foreclosures there.
No.
Such an interesting way
It's
of
a
doing it. I mean,
it's
everyone takes part in it where like
Right.
you just have to do what you promise you're going to do
That's exactly right.
from every perspective,
Right.
and then it works.
Right. So you as a developer, so people over there, the number one thing they look for is the credibility of a developer, right? Because that's important that you know, that you're credible enough that you're able to get all these checks and be able to cash flow them properly to make sure you're delivering the phases in the right way, you're building in the right way and delivering the homes in the right time. So that's why I
so
say
cool.
you're a bank
is
and
really
you're an
cool.
operation. Basically, you're really using other people's money to build the jobs.
So, yeah. So, would you? I'm just curious for people listening. Like, would you recommend? We can talk about it from a risk perspective. Would you recommend building outside of somewhere you live?
For me, that's an easy answer. The answer is yes, because I have roots in other places,
Right.
And it's roots in a different continent, 5,000 miles away. And I always wanted to, where I was born, I wanted to do something that is good for Egypt, right? And to me, I got a lot of experience from the U.S. There's a lot of stuff that we do here that is much better in terms of systems, and there's a lot of stuff that they do there that are much better than here. So having this experience is actually was very enlightening because, it told me a lot of what our strengths are here and what our lackings are. And yes, listen, Josh, I always say you live once, right? You got to take the risks. And if you're able to do something that's different, it's like exactly you doing this podcast. That's when you said that you're doing a podcast, I was like, wow, right? You're thinking of doing something, you just went and did it, right? I think it's going to succeed, right? But even if it doesn't, so what? You're going to try something else.
Yeah.
Right? The last thing you want to do is wanting to not taking a risk in something and coming back later and saying, I had the opportunity in doing something and I just didn't do it. Right. So, and that's a personality thing, right?
Sure.
I think that, yes, people should get out of their comfort zones because when you're in a comfort zone, you limit your ability to grow and you limit your profit margin. Why? Because you feel like I'm stuck here, so I have to take on this job because that's what's available. And you end up compromising yourself in terms of the return on your effort. You might be able to use that same effort somewhere else and make more money or become more successful. So it's okay to get out there and explore.
Now,
Sounds like the Egyptian development stuff for you is passion driven too.
Oh, absolutely. Absolutely. When I got the opportunity and it was to me, it was a no-brainer. Like it was a no-brainer. I'm passionate about it because I wanted to succeed and I want to be able to say I was able to go back and forth and make things happen that, far apart. I love Egypt. I have a lot of family over there. I want to do something different. We're doing a lot of, different things over there that other developers have not done before. I'll give you an example. There are no ADA laws. Doesn't exist. You've got the most stringent, building regulations, but it's something that, just was never thought of, right? It wasn't thought of. And as the more Western ideals kind of became open to the world, especially with a lot of social media and stuff over the last 15 and 20 years, there are things that was never discussed that are now like, we're going to have the first development in Egypt, the first 1,500 homes. It's going to be fully accessible. And it's
That's
being
amazing.
built on 17 different levels on the sea. And so anyone can leave their house and go to the beach without, there's ramps everywhere. There's just, it's accessible. Now the idea itself was like, oh wow, and now that is bringing a good value, right? A human value. And once you do it and it succeeds and you show that you're building not only for building, you're building while you're actually thinking about everyone that can possibly live there, and others will do the same thing. And then all of a sudden you started a good trend, right? All of a sudden, maybe someone's going to put in a code for ADA compliance and like, oh, great. Now that's something I'd be proud of if it happens.
That's amazing.
Right. And that's where I'm saying is it's so important that you bring what's good and try to spread it because it makes an impact.
Sorry, I was just going to say, like, kind of transitioning here, like you mentioned, taking on risk, doing things that are different, new. That's kind of how you guys have approached development in Philly too. You're developing in a lot of areas that some would consider are pioneers, new markets that others were maybe or afraid to tap into. Can you talk about why you chose some of the areas that you're developing in Philly and what you maybe saw that others didn't?
So it's very important when we're developing as developers, we understand where we're developing, right? So one of the things we always look at is where does risk come from, right? How can you lose on a job? There's two ways to lose on a job, right? One is that you're overestimating what you can sell or rent a unit for, right? I mean, that's the end user, right? And that can happen because you have a lack of understanding of what the demographics of your city is. That's one thing. Two is you build it for more than what you thought you're going to build it for, right? These are your two elements that can, two elements of your risk.
Less income on the back or more cost in
it's
the
very
middle.
simple concept, right?
Yeah.
And so
Makes
on the revenue end, for us, we looked at it and we said, well, this is a city that has a median income of $60,000, right? Who are we targeting? Who do we want to, in a down market, still be able to be the ones out there saying, hey, listen, we're still affordable for someone that's making median income. Okay. And we back engineered it and we said, okay, well, someone that's making $60,000 a year, that's $5,000 a month. If you are considered to be cost burden at 30%, that means you can't afford anything more than $1,500 or $1,600, right? What's $1,500, $1,600? You reverse engineering into let's say back in the days when interest rates were 4% mortgage or 3.5% mortgage, you're like, all right, that means you're able to, borrow $375,000 or $400,000. Okay, guys, that's what we're going to do. We're going to build $400,000 homes so that we can be targeting, at least 50% of the city would be able to afford it.
Makes a lot of
right?
sense.
And therefore, it's not going to take so much time to sell, right? Now, there's a challenge with that because the challenge with that is cost, right? So the question is for us was do you go with projects that are low risk on the revenue end because you're going to sell these homes because you got very little competition at numbers in these neighborhoods where you're like, okay, well, you can get less expensive than that, but have lesser margins, but be able to say, I'm going to be in and out in a 100-unit project, even on a for sale end, I'll be in and out in 18 months. And that's a calculation that's our personality. Our personality is we're a lower margin provider, right? But we'll be able to get in and out faster.
So it's lower risk on the revenue side, but it's higher risk on the cost side.
Well, it's higher risk on the cost side if you're right, if you're not, if you don't know
if you're
what
not
you're
dialed
doing.
in on construction.
Exactly.
Yeah.
That's where, someone like Larry, my partner, is he's as strong as they get.
Yeah.
And
it's
Larry, so talking about like Port Richmond, the other side of this is like location, right? So you know who you need to sell to, you know how much you need to sell to. Now choosing where to do that, I think that was also something you guys were kind of pioneering as well, because there weren't a lot of new construction in the areas you were working in. If I'm not mistaken, Larry was from those areas, right?
Absolutely. Larry's from Fishtown. He
Right.
still lives in Fishtown.
Right.
I think he moved for 3 years to Port Richmond and went back to Fishtown. He's like,
Okay.
you know, my wife felt out of place. I was like, wow, like literally half a mile away. I was like, I'm 5,000 miles away. You must be kidding me. If you're from Fishtown to Port Richmond and you're feeling that you're out of place.
The
It's like,
neighborhoods here are funny. They're so
is.
different when you
Right.
cross the street. You know?
It's your no. I mean, even if you know, it's like, oh, my parents live there, and then the neighbors, the people I grew up with.
Totally.
So even if you're just crossing the tracks and you're on the other side, you're like, you feel like you've gone to Jersey,
Yeah.
right? And it's not, but it's just the way people who grew up in the cities in specific neighborhoods, they're very attached to their neighborhoods.
True.
But I'll give you examples. You know, we've been very passionate about Kensington, right? About really making a true change. And, you know, we had this groundbreaking, I was telling you about 2 to 4 weeks away, where, you know, it's 4 different phases, but a total of 780 units, 780 apartments. The way we look at things is, if you go there today, it's the old scrapyard in Port Richmond. Next to it is a junkyard. Next to it is a railroad, yard. And we kind of like bought all of them. We're gonna create a city, like 800 units with its amenities and open parks. All of a sudden, can you imagine this being built? You've changed the way this looks, right?
Yeah.
So you can't look at it now and say, well, it's not going to work. Well, it's not working in your head because you're seeing what it is right now.
Right.
Once it's done and it's hard work and it's phasing and it's patience, right? It's really transformative to see these neighborhoods coming to a place where you're like, wow, you know, but it's risky too. It has an element of risk. That element of risk is a little bit on the cost side, but it's not on the revenue side.
Gotcha.
It's not on the revenue side because you're providing new construction units, beautiful units at numbers that, quite honestly, you won't find much competition with.
And sorry, go ahead.
It sounds like you're kind of just creating the demand by doing a project that large. Like, what would be riskier than that project would be doing a single family house on the block.
And there is.
Yeah.
And it's for $650,000, and God bless them.
Yeah.
Right?
Right.
God bless them. And I'm
Right.
like, that to me is risk.
Yeah.
But
Right?
But
now-
you're creating a community.
Right.
You're like, it passes the walking around test or it passes the sister
Right.
test. Would I want my sister to live there? Like, if it's a
Right.
big community, you know, it's a lot easier to feel safe.
Correct.
Tell us a little bit too. Like I've had the pleasure of seeing some of these communities that you've built, and you know, be in the houses and seeing what it's done for those communities. I think that doesn't get talked about enough. Can you talk about what that's done in terms of job creation, wealth that it's brought into this space, and how it's helped that community?
So, you know, when we talk about impact, I like to take examples and give you an example of one, and it gives you a little bit of perspective of the impact that these developments have on the neighborhoods and on the city, which is extremely important that you talk about, because in the broader picture of, you know, always seeing development and communities sometimes getting into that kind of like, you know, we don't want to see development, we want to see development, but we like the impacts of development, but we don't like actual development, and you get into that. Sometimes it's good to put the numbers to it. So we did Kensington Courts, right, on Lehigh Avenue. We took on this 4-acre used car dealership that had like 15 cars tops, employed 2 part-time employees, right, and had about $9,000 in taxes every year. And we built a job in 2 years, a $50 million job. And it created close to about $250 million in economic impact to the city of Philadelphia. The real estate taxes went up from $9,000 to like $200,000 with the tax abatement, with the expiration of the tax, with the abatement.
Wow.
Right? With the taxes actually being at full assessments, it'll be over $1 million.
Do you think you could have built the project if the tax abatement weren't around?
Absolutely not.
So that's interesting,
Absolutely
right? The
not.
taxes went from $9,000 to $200,000 a year, and you wouldn't have even been able to do the project if the abatement wasn't.
Oh my
around.
God!
Goes to the schools.
Right.
Yeah.
The abatement.
That's amazing.
So there's this. People talk about the development in neighborhoods, right? Mm. The development in neighborhoods happen really for two reasons. Only two reasons, right? It's low interest rate environment and the 10-year tax abatement.
That's a big statement to say, too. That's pretty wild to think about that.
It's very simple.
Yeah.
Right? You going and being able to buy a $400,000 home, a single family home in Kensington, was simply because your mortgage payment was only $1,400 and you had no real estate taxes. So someone making $55,000 or $60,000 a year was able to afford it.
Well,
once you have these two gone, right? That $400,000 home is going to have a $400 a month in real estate taxes, and your mortgage payment today would be $2,400.
Yeah.
And you're like, okay, right? You go from $1,400 to $2,800, right? So
it's crazy.
Now take that and scale it up to an apartment building because it's the same exact economics.
Yeah.
Right?
I mean, and before we even scale, real quick, talking about the $400,000 house, I think people have a misconception of how much money developers make when they sell a $400,000 house. That's going to cost, I mean, even if it's a smaller one let's say it's 2,000 square feet, that could easily cost $300,000 to build. And you then have to buy the land, you have to entitle it, you have interest, like your margins are very slim. So to actually execute on a $400,000 build is extremely difficult.
I will tell you, and I'll go on record on this, is that deep neighborhood developers would be 3 to 7% margins.
Crazy.
Wow.
That's it. And that's why scale is important.
It's important to realize this too,
right.
Because like this is like the 10-year tax abatement helps the end buyer. It's not boosting developers' profits. Correct. Because the project just wouldn't happen.
Right. And the tax abatement on even the apartment buildings that you're holding is what's actually making the deal pencil out to be built anyway. So there's this misconception, and this misconception is that these abatements are going to the pockets of developers and enriching them. That is not true. It's the difference between the job being financeable or not. It's not a matter of will you make money or more money, right?
It's doing it versus not doing it.
It's doing it versus not doing it.
And that $400,000 house, is that house available and on the market for someone to buy, or is there just no $400,000 new construction house?
Exactly.
It's an important conversation to have because most people don't understand the nuance behind that, where it helps the end user.
And that's where the politics. And that's where when the city doesn't have a unified vision. This is where I say where the difference is. I'm doing business.
Circle all the way back.
Right.
Yeah.
I'm doing business in a place where community, business, officials, there's a unified vision of where we need to head.
They all want the same thing.
Everyone wants the same thing.
Do you care to dial in on why that isn't the case in Philly?
Well, it's you're in a city that has it's the largest poor city in America, right?
Yeah.
High poverty.
Yeah.
Right? And you have neighborhoods, quite honestly, that have seen no development. You've seen poverty way more up in the Black and brown communities. You have seen developments happening in Center City in the 80s and 90s and then spreading to the neighborhoods. And then all of a sudden, people are saying, well, I can't afford this, and it's coming to my neighborhood.
Yeah.
You must put yourself in people's shoes to realize why we're in this situation. And I think the reason why we're in this situation is because there has not been a unified vision to lift people off of poverty. My opinion is dealing with poverty in the city of Philadelphia is mainly dealing with the symptoms.
So
right?
what does the unified vision look like then if we could be solution oriented?
Yeah, like you guys, so you and Gary proposed to the
Real
city.
quick, before we go on to that, I would love to see like what your vision actually, what does that actually look like?
To me,
Yeah. Like what does a unified vision look like where we're all lifting the poorest out of poverty?
number one, why are we poor? Why is the population poor? I'm asking you, why are people typically poor?
I think the most common answer to that would be lack of opportunity or lack of lack of options.
I think it's opportunity, education, and having truly a unified vision and saying, we're going to lift, and having actually a goal that says, we're going to lift X amount of people this year out of poverty, right? And this is how we're
Being
going to
clear
do it.
about it, treating it like a business.
Absolutely. You have to treat it like a business.
Yeah.
Right? I mean, opportunity. There's opportunity. You know, I chair the Philadelphia Accelerator Fund. We're providing opportunity for Black and brown developers, not through minority participation of contractors on city contracts. For the longest time, the Black and brown community, you know, you would get, for example, a city contract and you get, well, you need a 30% minority participation, right? To me, that doesn't help. It's okay, but it doesn't really help. It doesn't lift the people into the next level. Why do we not have a class of Black and brown developers in the city of Philadelphia? Why? Right? It's because that first step of opportunity does not exist. And it doesn't exist because for financing reasons, right? Barriers to entry, right? That we as a city and the business community, and looping back to the in a full circle to the plan of the Affordable Housing Action Plan that we put together, right? As the Building Industry Association is saying, this is not affordable housing is not only about lifting people and getting people affordable housing. It is we have an opportunity through public land, Accelerator Fund, and getting getting lenders and using and leveraging our relationships to create a class of Black and brown developers that actually do exist, but have barriers to entry. They do exist in terms of people who are willing to do it, able to do it, wanting to do it, and just needs that first step. And that is where I think is you succeed as a city. You succeed in a city, so you know, by reaching that equity that we all talk about through action and through enabling and giving opportunity to people, not by expanding programs to keep them poor.
So starting at the beginning with education, not the end with here's a job.
Correct.
Yeah.
Correct.
Here's education on how to become efficient and the best
Correct.
at what you do, and then naturally jobs will flow to you.
Education is number one. I would always say education is number one. But it's not even about good school. It means good school and good parenting. Remember, you can go to the good school, but you come back home and, you know, your parents are not telling you to do your homework or this, or it has to be. That's what I'm saying is this is not just one thing. It is education, it is opportunity, right? And it is thinking a little bit out of the box of how we have been doing business. If poverty rates are still hovering around 23 to 25% for the last, 30 years, 40 years.
Hasn't changed. Yeah.
We haven't changed. So what does it mean?
Something's not working.
Something's not working, right? Something is not working and you need to change. And that change means, in my opinion, right? If school is not working, you know, it's common sense stuff. If a school it's not working, the teaching is not happening, you know, in the right way, then you need to hold teachers accountable. If the parents are not doing their job, right, you need to hold them accountable. There has to be a way where, you know, you're holding people accountable along the way.
That's kind of that unified vision you're talking about.
Right.
Everyone taking
Right.
personal responsibility for where they are and then figuring out how to lift themselves up.
Absolutely.
Or we can create an environment that makes it easier to lift yourself up.
Yes.
So I want to. So we talked about the economics of it and the jobs portion of that. I just want to circle back to the affordable housing piece because I'm curious to get your perspective. We already kind of talked to Gary about that, about how the city and the development world can kind of work together. We kind of talked about, is there a way for land costs to be down? Gary mentioned the biggest being on the bank side about giving lower interest rates type things, CRE programs and such. Where do you think the biggest opportunity for affordable housing between the city and the businesses can kind of work together to develop that?
Public land. There is no other way. You can financial engineer specific deals here and there. But if you're talking about scale, and if you're talking about thousands of homes, and you're talking about opportunities to create a class of black and brown developers, we have to unify behind an affordable housing plan on public land, and you should have the metrics. You should say it's a 20,000 home plan that's going to be built by at least 30%, 40% of these homes are going to be done by black and brown developers, right? There is going to be guarantees from different city agencies on the construction loans, which, by the way, already exists in PHDC, right? Guaranteeing construction loans on behalf of the developers. Getting the lenders, right? Getting equity and getting products like the Accelerator Fund to come in and not have the front or seed money become your obstacle of becoming
your limiting factor.
Your limiting factor of becoming that developer.
Do you want to even talk about the Accelerator Fund a little bit?
Yeah, sure, absolutely. I mean, listen, today I'm going to the Black Squirrels Spring Mix event.
It's one of your 27 events today.
Right, yeah. and I admire them because and we had a role of some mentoring with the first cohort of about 10 to 12 developers, and we as the Accelerator Fund issued 7 or 8 different term sheets to that first cohort. I was on a phone call with one of them yesterday, and I was with the bank, Meridian Bank. Can't mention a bank, but a bank, and we were talking about term sheets, right? And we're like, well, we're missing this, and then I was working with the bank on the spreadsheets with them, and they're like, all right, we're going to send a term sheet today. So you're sort of
just facilitating.
Absolutely.
That's amazing.
And we need this.
Yeah.
Right? And this is the opportunity that we're talking about, right? The opportunity is not telling someone, go and attend a class, right? And you're on your own, let us know if you need anything. It means hand-holding.
This is actionable.
Exactly. This is me going on a phone call and be like, all right, let me call you back. I'm calling the bank and saying, what's the problem here? It's like, well, this number does not work with this. I was like, well, no, it works with that. They're like, all right. I call the person back. We're like, we're going to get a term sheet at the end of the day. This is what I'm saying. People who apply for public land, for the longest time, the obstacle for applying for public land has been that you have to show your capital stack when you're putting in the application. And if you're able and you're knowledgeable to do it, but you don't have the capital stack, which means the equity, the money in the bank, in addition to the term sheet from the senior lender. If you don't have that, you even the first step of just applying to the land, you can't do, right?
So I want to put you on the spot here because, I know we have an election coming up. I don't want to talk about the candidates, but let's say whoever becomes mayor comes to you and says, hey, Mo, I want you to help us with affordable housing and come up with this vision with us. Do you think that's something you could do and reasonably make significant change in, say, 5 years?
Absolutely. Awesome. Absolutely. I've already spoken with maybe 3 or 4 candidates.
Ready, willing, and able.
Absolutely.
All right.
Absolutely. It's something.
That's a good question. I like that.
And it's something that we have to do. We have to do
benefits
more
everyone.
Of. Right.
Exactly. And it really does.
Gary Jonas is one of these great guys.
Yeah, Gary's awesome.
He's an amazing guy, right? And we put a lot of time in taking that knowledge that you have and not just saying, hey, listen, I'm going to send you a pro forma, take a look at it. No, it's actually sitting with the people, going through it, answering questions, leveraging your connections until you reach the actual deal, right? It takes time, but it takes willpower, and it takes someone that is willing and is passionate about making a change. And that's what we need more of.
For sure. I mean, I think it's really clear you actually love the city, care about the city a lot. So that being in mind, to transition a little bit, what do you think, what's your outlook for Philadelphia moving forward as a business owner, as a developer, as a citizen?
Right. So Philly's not going to be different than a lot of other cities, right? When I say other cities, I mean, well, you know, the higher interest rates. Today I was on in a bank kind of roundtable when we're talking about some outlooks, right? Inflation is still high, right? It's over 5%. It's not going down as much as the Feds want it to be, because my opinion is the Feds were about a year too late.
Yeah.
They could have
Probably
done
agree with that, yeah.
right.
It seems to be the consensus.
Right. And we were enjoying this great lower interest rate environment. And when it got out of hands, it was like, and the $4 trillion or whatever trillions of dollars that went into the, COVID crisis, combined with the low interest rate for too long,
Supply chain issues. And
it created with the supply chain, it was just the perfect storm.
Yeah.
And, having 100 basis points increases and 150 basis points increases a month later, and it's still not happening. It tells me that you're going to see probably a couple of more rate hikes before the end of the year. You're probably going to have to see unemployment numbers go up, right? That 3.7, 3.8%, someone once told me that a very credible person is like, for you to reach that 2.5%, 3% inflation, you're probably going to need to see unemployment at 5.5%, 6%.
Wow.
I think Patrick Bet David said, I was watching a podcast from him. I don't know if you ever heard of him, literally like last week, and he said the same exact thing.
Right.
Like, and regretfully, it's not something you want, but it's the way the economics work out.
It's the way the economics work out.
Yeah.
Right. And the rate hikes are always will have a lagging effect. So whatever you're going through today is the effects of the rate hike from 6 months ago to 9 months ago.
And Philly tends to lag even further than that.
You're right.
Sometimes.
You're right. And so my outlook is that you're going to see a serious slowdown in starts of new projects at the end of this year and beginning of next year. You're going to see a serious slowdown because of deals not penciling out. You cannot underwrite deals, quite honestly, specifically in Philadelphia's neighborhoods, at 7% and 7.5%. You just, we're not built the city because it's a low revenue city, right? We're not New York. We cannot survive and continue starting jobs at these high interest rates, especially that your tax abatement now is now half of what it was. So combining both, the deals are not penciling out unless
and construction. I mean, have you guys seen a crazy increase in construction? Because I think we're probably up 30% from like 2020.
Right. The silver lining is that you're seeing that to start to soften, and that's actually kind of like what the interest rates are doing. It's just that the manner that it was done was too much of shocker to the market, and unfortunately,
too short of a duration. You mean?
Yeah. And I think it's going to get a little bit worse before it gets better, and that's okay, right? It's okay. It's not going to be a long-term thing. It's going to be, in my opinion, is you're going to see a 2024 and a 2025 both being soft, and then start seeing things kind of opening back up on starts by the end of 25. That's where I think things are going to go.
What would be your advice then for developers, business owners, or strategy for a slowing market? Like, how do you plan to operate in there?
Always be lean. That's one of the things that we were disciplined about in Riverwards Group, right? It is you have to be lean. In a city like Philadelphia, you have to be lean. If you're going to be a neighborhood developer and you're going to be out there taking that low revenue risk, developing in low revenue areas, part of limiting your costs is that you have to be lean in your company. And so my advice is, stay lean. Don't overestimate, don't overstretch yourself, right? Have a little bit of cash, right, to operate. Make sure you look at your revenue environment more than once in this environment to make sure, and your absorption, right? And don't do jobs that you don't have to do, right? Never take on a job because you have to take it.
Right.
Because that is a road to failure. And we've seen
What
that
does that
happen.
mean? Like, what do you mean by that?
Don't just take a job on and say, hey, listen, let me sign up this deal. I'll sign up this
I
deal.
don't have anything right now. I need to buy something.
I need to buy something.
Yeah,
I need to
yeah.
generate fees. I need to keep the,
Right.
feeding the monster or
Make
feeding
sure
the
it's a
machine.
good deal.
You cannot do that.
Yeah.
Once you start doing that, you're going to position yourself that when you're out of this, you're going to be like, oh my God, I'm pregnant with a couple of deals that I should not have done.
Yeah.
Right. And you don't want to do that.
Yeah.
Right. So stay disciplined, stick to your guidelines and criteria for underwriting projects. Okay. Assume the worst in terms of an interest rate environment for the next coming 2 to 3 years. Okay. And on the revenue side, also assume, a soft market, right? And don't, overstretch your projections and see what deals work. Remember, we're in a city that we have a lot of sellers that are old time sellers, meaning that people who have sat on these properties for so long. So if someone had bought a piece of property for $1,000 and it went up to $2 million and now it's going to be down to 1.2, it's not a loss of 800.
Yeah.
It's that these are paper values based on interest rates and tax abatements. So hold on, some of these land prices are going to come down. And so you have leverage in this market as a developer to go out to, landowners and making offers based on today's market. Hey, this is the interest rate today and this is what I can afford. And, if that land seller is smart, you're going to see a little bit of a period of stalling, and then you're going to start seeing sellers
Come back around.
They have to.
So
life continues.
Specifically, then going over revenues, I mean, as far as I can tell, interest rates rise, that lowers demand. So usually when demand lowers, prices come down, except supply is so low that prices have stayed pretty much even, maybe dropped a little bit in some neighborhoods. In some neighborhoods, I think we've seen prices increase. So how are you looking at deals right now from an out sale perspective? Are you being extra conservative, or do you have another metric that you're more focused on?
Well, so when people say supply is down, and how comes with supply being down, the prices are, people are still, having issues, in their absorption, and what are we going to do? And I always say is what supply? What kind of supply? Right? Because you can say overall you have a low supply, right? But whatever's on the market is all targeting 1% of the population. Might be the wrong supply.
That supply might be you're saying the luxury stuff.
Right. What I'm saying is housing is a broad industry, right? You have the deed restricted affordable units, you have low income housing, you have moderate income housing, you have lower end market rate housing, you have very high end market rate housing.
So it's kind of reductive to say there's low supply.
Right.
There's a bunch of different sectors, each with their own supply demand relationship.
Exactly.
Gotcha.
And that's what I always look at things is I cannot paint the city with a broad, but when I see these reports, they're total monthly sales and this is the supply. And I'm like, what does that mean?
Supply of what?
Supply of what? Right? You can build 5,000 apartments next year, but if they're all at $3.50 a square foot, right? You're targeting, specific clientele.
Specific demographic.
While there's going to be such low supplies for people who are looking for $2.25 a square foot rentals. So we have to look at these in categories and not in a broader scale.
Is there a specific sector that you are ultimately interested in right now in this environment?
I'm always bullish on our median income guy.
Yeah.
Right? Or girl. For me, it's about that middle person. To me, that's who we as a company have always bet on, right? Is that middle market, right? This is one person making $60,000, two people making $45,000 each, and so a household of $90,000. We bet on them. Why? Because it's median income, right? These are people that look for housing and can afford to pay $17, $18, $16, $1,500, right? And they will never go away as a demand.
So we
I love that perspective. Sorry, real quick. Just I've never heard it talked about like that. Like you're saying, I'm betting on this group of people.
Absolutely.
Like that's such a cool perspective. You are betting on the median.
Right. I
That
think
makes a lot of sense with your investments. That's who you're actually you're counting on them.
Yep. That median income person, by the way, is in a low interest rate environment was able to afford a $400,000 house. In a high interest rate environment is looking for rentals. That median income person is, or a household is a household that's making $60,000, $70,000, $80,000 a year. It's not like they're making less $20,000 a year.
Yeah, right.
Right. And I always say, and they need housing, right? They need housing, right? And in my opinion is that we're missing out in the middle markets. And that is why we try to be able to have our deals pencil out. We have to go in areas where the land is extremely inexpensive, and hence our plan always going into these outer neighborhoods is for us to be able to target that $60,000 to $75,000 a year person.
Makes sense.
The only way to do it is to have a project done on land that is inexpensive.
So then talking about the short-term versus longer-term vision for Riverwards Group, it sounds like, betting on the middle class, betting on these specific market groups. Are you guys going to continue to build the way you're building in Philly? Are you looking outside of Philly, or is it just, hey, we're betting on this area of Philly and we're just going to keep going with the way it is?
So right before, probably towards end of 20 or middle of 2021, end of 2021, we actually, grouped all of our investors and said we want to create a fund and we want to take on projects outside of Philadelphia or even Pennsylvania, look at other areas of the country. And, there was a lot of good traction to it. And it was something in our plans. And with the interest rate hikes, it was kind of like, all right, everyone just let's focus on what we have and the projects that we have currently and make sure that you can finance them and you can build them. And it's something that we want to do.
Okay.
And we had plans to do it and we were raising funds for it, but then everything kind of slowed down these plans. And again, it's part of our discipline. We don't have to do it. So, you don't have to do something for the sake of doing it. You have to do it in an environment that you're respecting your investors' money.
Yeah.
And respecting it means make sure that you're not gambling with your investors' money, making sure that you're going to return that money and you're going to return it with the with the return that you've promised. Because guess what? I was once told, if someone invests with you $1 and you bring them back that dollar with the return, their next investment is going to be $5. The following investor is going to be $10. And that means your growth. So our growth as a company lies in the hands of investors and the capital that they can provide us. And their trust and their confidence in us will only come from the experience of us.
Totally.
Are we delivering on our promises or not?
So you had to say, hey, this is the right idea, but it's the wrong time.
It's the wrong time for it.
Yeah.
Right.
Well, on a more personal level, I mean, this is a question I like to ask everyone because I'm personally very curious about this, and it's something that we, have. It's been an obstacle for us as we've been growing our company. How do you, as a developer, manage the short-term cash that's needed to actually run the business with the long-term, exciting wealth building aspects that makes us all love real estate, which is the buy and hold that tends to be fairly expensive to do?
It's my favorite question, so no pressure.
No.
It's always my favorite question because
Yeah.
we ran into an issue with it where we were holding too much. We didn't have any for sale stuff. And then we were like, holy crap, where's our cash? And we had to sell some stuff that we were planning on holding. And now, we're still sort of looking for that balance.
It's not easy to find that balance. So, I'll give you an example. We have been, even the way we structured deals were that we're going to build buildings, stabilize them, and sell them. Right? We're not going to hold them because, again, we borrow our equity, and we're cash poor, building the job, and our upside is really always on the exit, right? That being said, I think it's a balance where, part of you thinking you don't have a balance is that you're not planning on what to do from day one. Meaning, like Lara and I, we start a job and saying, we're not keeping that job. We will keep that one. We will keep that one. We're not keeping that one.
Mm-hmm.
So we're not thinking twice about it, and we're being disciplined about it.
Mm-hmm.
Right? So I think what happens is, you know, the idea of long-term wealth gets you into that kind of sometimes the mode of I need to keep everything.
Mm-hmm.
So we were talking about it actually 2 days ago, and we sold a project, and I'm like, Larry, 10 years from now, when it's double the price, you cannot look back and say, I should have kept it. You cannot. That's unfair.
Mm-hmm.
Because keeping it would have cost you X amount. You would not have received the cash today that you're investing or doing other stuff. So it's an unfair, you cannot look back this way.
It's a good way to look at
Yeah,
it.
that's a good
And
answer.
I always say is like, don't have that regret, but you always have to, you cannot be, especially if you're a growing developer, be cash poor all the time.
Mm-hmm.
It's discouraging, which I'm sure it is.
100%.
It becomes discouraging because you're like, all right, I own these units, I own this building, and
Yeah.
but I'm poor.
Right.
Right. It's all great. It's all equity. It's all equity inside.
Mm-hmm.
Well, you have to realize some of that cash, right? First of all, for yourself, for a rainy day, and like you said, you need to balance it. You need to determine what it is. What's your goal, right? Is it I'm mentoring someone, and that someone came in and was like, he came in with great ideas. He's like an 18-year-old kid that I'm mentoring through jobs and then through college and all that. And I'm saying, what's your 5-year plan? And he's like, what? I'm like, all right, so that's the first thing we're going to do.
Mm-hmm.
You're going to tell me in 5 years what you're going to be making and what you're going to be doing.
Mm-hmm.
That's all that I want from you. Just tell me that last goal, 5 years. And then all that we're going to do is work our way backwards and see what the steps are taken. It might be 10 steps. It might be 4 steps. I said, I don't know. But you just need to tell me what that end goal is. Right? And then we'll work our way through it. And I think part of it is you need to have a real goal for the 10-year goal. Are you gonna own 100 units, or do you wanna have and hold 1,000 units, or is it 300 units, or is it 20 units, right? And if you know that number, then you're not gonna just wing it and say, I'm gonna hold everything that I'm building for now, because you might be over leveraging yourself, and all of a sudden you're like, what am I gonna do?
It's such a good point that it's not a fair comparison, because that money that you get from this sale, it's like you use that for other deals. Right. And then it compounds on top of itself just in a different way.
It has a different path.
It's such a good point.
You're probably in a
We've done that too. We're like, damn, that one's now worth double what we sold for 3 years ago.
No, it's not. You took that money and you invested it, or you did something else with it.
So true.
It doesn't matter. But, our mindset is always like, oh my God, I missed out on all this upside. It's like as if that upside came by you not doing anything and no effort, and that upside just came with no pains.
Yeah.
That upside comes with you operating it, you losing some cash in the stabilizing years, and you have issues, and higher interest rates, going through a recession and evictions and up, and like it's you're not inheriting it. You can't look back at it.
Does doing we were kind of thinking about how you operate, with the larger volume of the amount of deals you're doing. And you kind of talked about this when we were talking about Egypt and the phasing. Because you're doing the phasing and the large amount of units, does that really help with the risk side of having short-term cash flow, having that, okay, we're selling this phase, it's going to help pay the bills. And then, so we don't need, a deal right after this project's done kind of thing. Like, does that help you? With the volume, is that part of the strategy?
Well, absolutely. You have to know what your pipeline is, right? So having what the pipeline is and the pipeline needs and the planning is when you say short-term cash flow, I would say, one of our main backbones of the company is our controller, Cindy. Hey, Cindy. So
shout out to Cindy.
Shout out to Cindy. So we call Cindy Mom. Right? We call her Mom because we've known her for like 20 years, 25 years. She's a great person. She is, Italian. She beats on us. She's like, you know, you're not spending this. We need to preserve cash for that. We need to make sure this is
She's the enforcer.
She's the enforcer because again, we're a couple of guys who are going. I was like, hey, Cindy, you know, we got to award this job, and we're gonna do this, and we're gonna do that, and be like, whoa, who's paying for this?
Yeah.
You are, right? You're like, nope, don't have money in this account. What do you mean you don't have money? Well, you spend it on this and that. So you need that someone. It's great to be ambitious. It's great that you have plans, but you need always that voice with you that basically says, you know, in the company, in your organization that says, okay, I'm with you. I'm with you on your growth plans, but I want to be sure that that short-term cash flow is managed so you don't get yourself and get us all in trouble.
Like that push and pull. That's good. The tension is good.
You need it, you know, because if you're sitting with someone or a CFO or a controller that says, yeah, let's do it, right? And 6 months down the road, you know, you can't make interest payments and you're like,
what happened?
What happened? Like, well, you guys wanted it. It was like, yeah, but you're supposed to tell me, stop, or plan for it more, or raise more money for it. So it's very important that you do it this way. Now, in this day and age, in where we are today, in slower sales, slower absorptions, I think people are paying so much more attention to the short-term cash flow to make sure that, you know, not for the next coming 3 months and 4 months, they're looking really down, in my opinion, that 12 to 18 month period, right? It's going to be very crucial, very important for a lot of people and a lot of developers.
All right. Well, we are going to jump to the tail end. We have 3 questions that we always end with. So the first one is just, first and the second is, what do you consider to be your best and your worst deal?
It's up to you. Any criteria?
Yeah. Worst deal. Let me start with the bad news first. So worst deal was very deep in Port Richmond. It was in the start of our career. It was a 5-home project. And it was, so we've done dozens of projects. We've never lost money except in this one. We lost like, I want to say, I don't know, like $40,000 or $50,000 a house.
Oh gosh.
Right. And that's in the starts 5. Thank God. It was the beginning of our career.
Yeah.
Right. And the reason is because we were not disciplined. When we said we are going to stay on a course, it was one that we did not stay the course. What do I mean by that? One of the things that we do and we say, remember we said reverse engineer is saying this is a neighborhood, this is who's going to buy, and therefore that's our end user pricing, right? With that end user pricing, if you want to make X amount of money, well, the maximum I can build this house is, or you know, is X amount of money. I got to spend $250,000 to build that house, or $220,000. Well, what can I build for $220,000? I can build a, whatever, 1,400 square feet. Okay. Then that's the program. I mean, that's how we do it.
Right.
This one, we said, oh, you know what? You know, we need that 4th floor and we're going to create that deck. And we're like, do we really need this? Like, yeah. And the architect really got us into it.
Got excited.
And got us excited about it. And we got excited about it. It was like, you know what? Yeah, maybe we push pricing for that, you know, in a market that like 10 years ago was like, there's nothing with a 3 in front of it. It was like, yeah, we're going to push it to like 375, 380. And it's, you know, it's going to be the perfect house for that number. We couldn't get past that 325 mark or like 315. And some of them were like 295. There wasn't a market for it that deep.
Yeah. And
we're like, the reason for it is we could have said, no, we're sticking to our 1,600 square feet plan. You know, that's what we need, a 3-bedroom, 3-bathroom, a 3-bedroom, 2.5 bathroom.
We know this sells.
This is going to sell. It's going to be targeting that. We let our guards down. We lost money on it. And it was something that will always stick to my head because every time I look at a job, I remember this job. I'm like, we're going to be disciplined in exactly who we're targeting here. I am not going to sell a $600,000 home, right, in an area that a maximum price that was ever in that neighborhood was $295, right? Then
it's probably, that lesson probably helped you, it sounds like.
Right.
Because you learned it on, for you, a relatively inexpensive job.
Absolutely.
And now you're doing much bigger stuff.
Absolutely. And the best job, I would say, you know, that really touches me is really Kensington Courts. I mean, we've done 2 or 3 huge jobs and we're doing now bigger stuff. But Kensington Courts for me was a real transformation because there was just a lot of pushback by a lot of people who would be like, you must be kidding me. Like, remember our site was right where, it's so sad when you see the opioid epidemic taking over a neighborhood.
Mm-hmm.
So the whole sidewalk was needles. People were, shooting up in our grand opening.
Oh gosh.
We had people walking and they're falling, and then we had a lot of people right on the underpass where our project is. Like, it was a sad look, and you feel bad for the people. But people would look at you and be like, "You seriously are going to build like $400,000 homes here, or $375,000 or $380,000 home? This is just not happening." I got one investor that went on a roof deck on the other side of Lehigh, where we did a job called Avenue 30, and looks at me. He's like, "Mo, I will never forget it." He's like, "This is not going to happen." He's like, "I'm not investing in this one." So, you got to be comfortable.
Totally.
I get it, and 100%. And for us, it was a challenge. And when it was done, because it was a 4 or 5 acre, we created a neighborhood. You go now down Lehigh Avenue, it's like you're driving like a quarter mile. The whole thing is
Looks
completely
totally
different.
It
Yeah.
looks completely different. And it gave us that courage to cross the tracks and do something big over there, because now you have proven that there is a market for that stuff. People are looking for shelter. People are looking for that. My opinion is that $1,000 to $2,000 monthly payment, whatever that gets you. If it's in a low interest rate environment and gets you $500,000 home, then that's what you target. If it's in a high interest rate environment getting you only a $350,000 house, then that's what you should do. But that $1,000 to $2,000 is affordable by people making anywhere from $40,000 to $75,000.
Gotcha.
That's where our sweet spot is.
Makes a lot of sense.
Yeah.
And we love this job. It's been a tremendous job, and we've moved a lot of families in areas that into single family homes that otherwise would not have.
Is that sold out?
Completely sold out.
That's nice. It's like also kind of it's nice to prove people wrong when they think you can't do something too.
Yeah,
You know?
and it's not really more about proving them wrong as much as it is
Proving you right.
proving us that the case of that middle market that exists.
Totally. Yeah. Yeah. It sort of backs up your thesis.
Right.
Yep.
Confirms it. All right. Well, our last question that we like to ask everybody is, if you today were to lose all of your assets and all of your network, how would you restart today in Philly?
In Philly, if I lost all the network, how would I restart? I would.
You can still know what you know now, but that's it.
The knowledge.
You have the knowledge still.
Got all the knowledge, but God comes down, snaps his fingers, and you lose your network and your money.
Network and money. All right. So I would run to the land bank. Run to the land bank. It's low equity deals, right? You're buying lots for nothing, and you're going to be putting affordable housing. And so the equity requirements and all these deals, you said I have the knowledge, right?
Yeah.
So these are extremely low equity required jobs, right?
I have always avoided that because I thought it was administratively almost impossible to get it.
It's difficult. The process is not easy with the land bank. Now it's much easier,
Really?
especially with the introduction of the 1,000 turnkey project plan by City Council President Clark and the MPI by Council President Clark. There was actually a piece in the Citizens yesterday about the land bank, the complete change from 22 to 23 now.
180,
Yeah, it's a complete change. To me, if I have to restart, because, okay, give me a $1,000 lot.
Yeah.
Right? And you go to the bank and be like, I don't have site improvements. I'm going to buy this lot. Just give me the construction loan. So
I mean, that's kind of amazing. I didn't even know about this.
Yeah.
Right.
Need to look into this.
Yeah, you should.
And you're building affordable housing?
You're building affordable housing. Well, you technically can apply for series of lots as long as you have 51% of these homes as deed restricted affordable housing. And affordable housing, in my opinion, even though it says up to 120% AMI, I would say it's probably up to 100% AMI, deed restricted for 15 years. The deal works when you have land bases of nearly nothing, right? Your A&D portions of the loans are basically the soft cost of designing it. Land is for free, pretty much, and then you're getting a construction loan.
That's amazing.
So your risk is so much lower. Your margins are lower, but if you're saying you're restarting and you're starting from scratch, that's why we're saying through the Accelerator Fund, with the 51% affordable housing component to it, which ties to the guidelines on the bank sales, that these complete each other as an entry point for a lot of minority developers. Start your business now in this. You're now doing two things. You're empowering Black and brown developers in the neighborhoods, and you're providing affordable housing at the same time, right? And you're getting rid of public land that is sitting there that requires a lot of maintenance and is, when you have a lot of infills that are vacant, that means more crime and less security. So look at like if we rally behind a program that says in the next coming 5 years, we're building all these lots. And we're going to do these 2-story row homes, it's going to be affordable housing, and the whole city is going to come rally behind it, right? You've got $1 billion worth of land in the city of Philadelphia, right? You leverage it to bring in another $3 to $4 billion to build them. All of a sudden you have a $4 or $5 billion plan that actually works, unlike other plans that we're hearing about these days in the media that are kind of fictional. Like,
all right, politicians, here it is.
Right. So you go
Let's
to
end with some spice.
right.
Yeah.
So you rally behind that. That $4 or $5 billion plan, right, will have a $10 to $15 billion economic impact on the city, and the whole city can rally behind it, and everyone benefits from it. There's no one. It's not on the expense of anyone else. You just need to get the politics out of it. You need to get our politicians on the same page. You need to have an administration and council that are working together along with the private sector, with nonprofits. Everyone needs to be part of this plan, and we should all rally behind it.
Amazing.
Can't think of a better way to end it.
Yeah.
That was great.
That was awesome. Really
Yeah,
great
so-
conversation. We appreciate
Absolutely.
it.
Yeah, thanks, Mel.
Thank you for having me. This is great.
Absolutely.
This is
We'd
great.
love
Thank
to have
so
you
much.
back.
Absolutely.
Yeah,
Thank
thanks.
you so much. I
Thanks.
appreciate it. Thank you.
All right.